Trying to join a Zoom meeting here. I'm not. Oh, maybe I'll finally get on. Yeah, just push. Later.
Recording in progress.
Okay, so September 11th, 2023, 1:33 p.m. Call meeting to order. Here we go. Thanks everybody for coming short notice. It was short notice for all of us. So, yeah. Okay.
What's up?
The table's yours.
All right, financial statements. You want to go to the next page after the table of contents? We'll just start there. Yeah.
Right.
Management responsibility for financial reporting. That is essentially management's report or sign off that they are responsible for the preparation, accuracy, objectivity, integrity of the financial statements attached. There's no opinion, it's just that you take responsibility for the statements. The next page is the auditor's report, which is our report stating whether or not the financial statements are attached are in accordance with public sector accounting standards as required with the local governments. This is a standard clean audit opinion. We don't have any qualifications, exceptions. And we're stating that the financial statements provided are in accordance with the public sector accounting standards. So it's a couple pages long, you'll see there. If you go to page 4, we'll get right into the numbers here. So statement of financial position, page 4, or most commonly known as a balance sheet. I'll just start at the top, work my way down. So the cash and short-term investments, about $270,000. If you go to note 3 on page 18, you'll see what makes that balance up. So we have about $36,000 in the bank account, $233,000 in short-term investments. So you'll see that overall cash and short-term investments have gone down about $90,000 there. But if you go down to the bottom of the page, you'll also notice that long-term investments, you've had a GIC in there, and it was $80,000. It's been now included in short-term because it's maturing, or it has matured. So overall, you have a decrease of about $168,000 in cash resources. The decrease mainly attributable to capital project spending, where you have used operational cash to fund those projects until you receive the grant funding. You know, MSI Capital, Canada Building Fund, those items, you get their annual allocation. So until you submit the project and incur the costs and submit it to those granting agencies, you won't receive the funds. But just while we're on that, on a side note, you did receive, I think it was $460,000 in MSI Capital Fund in July, so you did receive quite a bit of funding. Just some notes on the cash and short-term investments. Your bank account's paying interest at prime plus 0.25%. The short-term investments are earning interest, or were earning interest at 0.8 and 2.5. They have maturity dates of January 23 and December 23. Those are a little bit low, so I would reevaluate whether you want to keep it in your operating account or you can find a better deal. You earn a little bit more investment or interest income there. You'll see also you've designated funds of $215,000 approximately for restricted surplus. So essentially, you're supposed to put money aside, or hoping to put money aside to fund future projects. However, at the end of 22, there's a deficit of about $20,500. So if you take your cash balance of the 269 here, and you take off the restricted grant funding in the third paragraph there, 65,000, and then you take off $9,820 donations, you're less than $200,000 left, right? So you've put some of your unrestricted surplus into restricted surplus. And the idea is to have the cash to back that up. However, this year, based on your cash balances, you're unfunded by about 20,000. So I anticipate, of course, that's changed already
Yes, it has.
due to the receipt of the funds. It was a temporary situation. Just back to that restricted amount of 65,446 in grant funding. So that's the actual cash you've received in grant funding that's in the bank account that's restricted. Because you'll see some numbers here that are different in terms of deferred revenue for grant funding. Because we set up the full receivable, your allocation. So if you were going to get 100,000 of MSI capital for 2022 and you hadn't received it yet, we'd record a receivable. And then if you didn't spend it, 100,000 deferred revenue. But of course, it wouldn't hit the bank because you haven't got it yet. So that's why that number is not going to jive as we go through this. Taxes receivable, note 4. So you'll see last year at the end of 21, you had about 90,000 receivable. This year, only about 50,000. So it's actually improved. Of course, with COVID, it's hard to compare over the last few years. But going back to 2018, it's even lower receivable amount than that year. So your current arrears are all down. The arrears, it's about 4 different accounts. It's not pervasive across the village, so it's concentrated specific. You'll see an allowance there. That's an allowance for doubtful account. There were a couple accounts that you may not get. It's on the less than 50% chance side of it, so we reported the allowance. So there has been a corresponding expense of bad debt. But if you have a recovery, then in the year you receive it, then it'll be income. Trade and other receivables. So 1.265 million, about 120,000 more than last year. Mostly that's made up of the grant funding that you're allocated. So the federal gas tax grant, or Canada Building Fund grant, is now called 350,000. So it added on 50,000 for your 2022 allocation. And you have your MSI capital grant receivable of 886,851. Those are the main items. So the federal gas taxes from 2018 to 2022, those are all inclusive, those years' allocations. The MSI capital is the 2017 to 22 allocations. But as I stated, your 2017 to 19 funds were received in late July 23, totaling about $846. So now for MSI Capital, unless they've backed off on that, they are starting to have expiry dates on these funds. So 2018 was set to expire at the end of 23, or is. But of course now you've received it. So it's just important to watch those dates because you don't have to lose your allocations. So make sure you get the projects submitted and commenced. Kind of touched on long-term investments. It's down about 80,000 because your GIC last year would have been long-term because in 21 it didn't mature in 23. So now it's short-term. Accounts payable increase about $41,000 compared to 21, mostly due to capital project payables, right? Just timing. About $40,000 due for capital projects at the end of 22. Deferred revenue, pretty consistent with the prior year. You can see on the page 19, note 7, what makes up the deferred revenue. So you've got the Canada Community Building Fund, which is federal gas tax, name changed, and then the MSI grants, 335,000 and 952,000. So about 1.3 million total deferred revenue. So as I stated, we've got a receivable and a deferred revenue because you haven't spent it yet. And you'll see that there's been a prior period adjustment. So in 2019, there was about, I think it was about 50 or 60,000 in relation to converting MuniWare. Was about 40,000 of that from MuniWare, or from VADM to MuniWare. And then there was a Kubota purchase, and then the difference on the skid steer trade-in. So those items were submitted for grant funding to be covered by the federal gas tax. However, subsequently it was discovered that federal gas tax would not allow those funds to be used for those projects. So we had to amend the financial statements. Now, some of those items can be funded retroactively with MSI capital funding, which is what you guys are doing. But the MuniWare item or costs 30 to 40,000. Those they don't get covered by grants, so they come straight out of your operation. So overall, your deferred revenue for federal gas tax, so now you have more funding available, increased by about 65,000 at December 31st, 21. And MSI grant deferred revenue was decreased by $4,900 because of using it for the skid steer trade. So overall, yeah, there were specific capital projects for which that funding was applied. However, they were disallowed, so that funding is now carried forward for different projects. It didn't change your bottom line for 2021, it just changed your surplus total going forward. Just if you look at page 4, statement of financial position. So now we've been through the assets and liabilities. So you'll see that figure, net financial assets debt. So yours is positive. Sometimes you can see that negative. Most of the times what that means is a municipality is funding their TCA with debt, with debentures. In your case, you don't have any debenture debt. You're in a positive, but you see it's gone down by about 100,000 compared to the prior year. And as I stated, that's because you're drawing on your operational funds to your capital projects. So again, this number, as you get your grants, will increase. Essentially a measure of, are you able to take your cash and pay your liability? Under non-financial assets, I'll bring your attention to tangible capital assets and direct you to schedule 2, page 9. So on that schedule, you'll see all the different types of capital assets, land, buildings, etc. And it'll show your total purchases by category for the year and your disposals. So I'll just give you a rundown. So you did do the skid steer purchase and trade-in. You bought a standby pump, a valve exerciser, some skid steer attachments. You had the pump house upgrades and generator purchase. So you spent about $292,000. Of that, $114,000 was funded by MSI capital funding. 88,000 from the trade-in of the skid steer, and about 90,000 was funded out of operations. So about 186,000 of the capital purchases are not in use and not being amortized or depreciated yet, because the pump house isn't in use yet. Total amortization for the year or depreciation is 110,000 and change. So that's a non-cash expense. It's just, you're not gonna buy $1 million asset and expense it in year one, so you're gonna expense it over time. So back to page 4, the last line item, it'll show accumulated surplus. So that's made up of 3 different funds. Your unrestricted surplus, your restricted surplus, or what can be known as reserves, and your equity and your property equipment. So on page 19, note 8, you'll see the breakdown of those 3 funds. So your restricted surplus is what council and previous council have set aside out of equity be restricted. Your equity and tangible capital assets is your depreciated accounting value of your capital assets, and your unrestricted surplus is what's left over. Again, since you funded about 90,000 of capital purchases through operations, that number has gone down significantly. We'll head to page 5, the statement of operations. So we'll go through your revenue and expenses. So your taxes within the budgeted amount, there's an increase about 3.6%. This amount is, the amount showing there is net after deducting the requisitions for school. That's about 60 grand. The government transfers, if you look at page 10, there's a breakdown of what makes that up. So yeah, at the bottom of page 10, schedule 4, you'll see the federal government operating amount. That's just the Canada Day grant for $650. The provincial government grant is the MSI operating funds that you get annually. Those funds were used to fund various operating items, including streetlight costs, etc. Last year, you'll see that the provincial government funding was quite a bit more. That's because you had that most funding, which was a one-time thing. The other local funding is the county and FCSS funding. So you'll see the capital funding, the provincial capital funding, that's all MSI capital funding to fund current year projects, as well as to retroactively fund some of those projects that were disallowed in prior years. That was 140,000 change. Back to page 5. Continue on there. Sales and user charges, so that's water, sewer, garbage. Pretty consistent. No changes in rates. Rentals, that's medical clinic. I think pull-ups in there too. The gain on sale of tangible capital assets, that's the skid steer trading. So you're gonna depreciate your skid steer, and then whatever you get in the less than depreciated value is your gain or loss. So it's just an accounting gain or loss. The other income down because there's insurance proceeds received regarding hail in the 2041. Expenses pretty consistent overall. The legislative and administrative differences, there wasn't anything out of the ordinary, just standard fluctuations between accounts. Protective services. In 2021, we had that police funding we had recorded about a year and a half of it. It was missed being recorded the year before. So that's why it looked like it's gone down. But it's about $8,000 a year for the police fund. Transportation. Again, nothing out of the ordinary that we found in the accounts. It's obviously what you're going to spend from year to year and what repair is going to be required. Things can pop up, or one year you can have a whole bunch of unexpected repairs, and the next not so much. So it's pretty comparable overall, under budget. Water, wastewater, same as roads and streets, transportation. Didn't find anything out of the ordinary. Chemicals, supplies, repairs in there. Waste management, very, very comparable to budget in prior year. SCSS, you'll notice about a $10,000 increase. So there was some LAPP contributions. Some employees were eligible to contribute, so you had to match that. So that made up part of that increase. The Christmas stocking expense was up by a bit too, but you did receive more funding in that area this year, so it did offset what you received. Recreation and culture, fairly close to budget, but up 18,000 from the prior year. There was 23 picnic tables purchased for about $10,000. So due to the fact that it's per picnic table, it's so little, it doesn't meet your capitalization policy, so they were expensed. Library repairs were up. So there's assessments to survive viability. And you'll see the amortization, 110,000. So again, that's a non-cash expense. So overall, before you take into account grants for capital funding, you had a deficit of $136,000. Once you use the government funding, now you get into a surplus. But again, you didn't spend 110,000 on that activity. I'll go to the next page. So statement of changes in net financial assets, debt. So that's a reconciliation to take your revenue and get to your net financial asset debt figure. You look at the bottom, that 183,000. So that was on your statement of financial position, the assets less the liabilities. You'll see if you take your revenue and adjust for purchasing tangible capital assets and amortization and so forth, you come to that number. It's just another way to demonstrate it. Statement of cash flows on the next page. Essentially at the top, you have the difference between your balance sheet items between the current and prior year. which we went over already what the differences were there. You'll notice under capital activities, you only show capital purchases of 250,000. That's cash paid. You had about 40,000 that was payable at the end of the year, so I had to take that out. The proceeds mostly on the skid steer, but he did sell an old piece of equipment for 1,600 or something. Forget what it was, like a snowplow or something. The change in long-term investments, that's that change in the long-term, short-term PIC. The page 11. Expenses by object. So that's just a different way to show how your expenses are categorized. On the statement of operations, we have by function, so legislative, administrative for here. You see, we have wages, contracted services, materials, utilities, your big expenses. Again, fairly comparable from year to year. Salaries and wages, so you would have a little bit of increase in rate, and then those LAPP contributions. That's why it's gone up. Contracted in general, as I stated, the police funding was inflated in 2021. Materials, utilities increased about, increased about 20,000. Less than budgeted. Again, the picnic tables was 10,000 of that, and there was some computer purchases with 2,500 in there too, and street light costs go up, utilities go up. So go to the next page, segmented disorder. So another way to show your statement of operations. So it's kind of melding function with object. So we have the function at the top going across, general, government, protective services, etc. And then the object, sales and user fees, contracted government services, etc. I think the best thing to key on this statement is the bottom where it says net revenue, and then you can see and compare it to 2021, 2 years. So you'll see the government transfer income decreased in the general category. We had discussed that before. The most funding was received in the prior year, so that's why a good chunk of that is that's why, because it went from 191 to 157 at the bottom. The main difference there is that most funding wasn't received. You go over 2 columns over to environmental services, you'll notice that you're in a deficit last year, but this year net revenue. So you've used more of your grant income this year. That's why there's a positive for the pump house. And then the recreation, you'll see a increase in the deficit again, the picnic table. Right? We'll go into the notes. Just a few we want to highlight. Note 2, page 17. Specifically, G, asset retirement obligations. So a good example of an asset retirement obligation, if you own a building and it has asbestos or some other issue. Yeah. Yeah. So there's a new standard beginning April 1st, 22. So it'll be effective for your 23 financial statements, where you're supposed to record a retirement obligation. So if it's gonna cost you $20,000 to retire that asset, but at the end of its life, then you have to record, increase the asset value, increase the liability.
But if the building is gone, then you can not have to record the.
Right, the building's gone. Yeah. Unless there's a contingency where something comes up, you have to pay for it with the new owner.
And I think that was pretty clear as is.
As in,
Yeah, all the testing, all the information is there, so.
So that's part of the reason for these assessments, the cost. But also, you do wanna know if something's falling down. Right?
Mhm.
You don't wanna have that liability, somebody in there and gets hurt, so. So that's coming up, so we need to make sure that we have that recorded next year. Note 10, page 19. Oh, sorry, must have went spilled on the note for page 20. Yeah, so just a breakdown of amounts restricted. So your total is 215,000, and then the categories by which where you're gonna fund future projects. And that can be changed at any given time. It's just a matter of you review it and decide where it was better allocated. Note 11, salary and benefits. It's a required disclosure for CEO, counselors, and designated officers. Next page, debt limits, page 21. So of course, municipality can only borrow so many funds, so much funds. It's all based on your revenue. So you could borrow up to $960,000. At present, no long-term debt debentures. Next page. It's a few paragraphs down, you'll see operating lines of credit. So this will bring your attention to that. You have a line of credit of 50,000 or overdraft of 50,000, of which there was nothing overdrawn at year end. There's also MasterCards or credit cards with a $30,000 limit. Again, nothing's drawn down on them. They're treated like payables from MasterCard, so it's paid off every month. Note 18, page 23. So just mentioning your agreement for the waste collection and how it's priced. And then in the first paragraph, you did enter into an agreement with the county, I believe, to receive that rent funding. So that expires in 27, so it's good for another 5 years. Well, $32,000 and then, or sorry, $38,000, 23. Note 21, it's just another summary of how the numbers have changed due to that prior period adjustment. So overall, there was about $60,000 that was funded with the grant back then, and then disallowed. So those funds are restored, but those funds come out of the funding of the capital project in that operation. Okay. That's all I had for the financial statements themselves. I do have some letters and so forth. Any questions on the financial statements?
nice.
So we're kind of stable then, we're not doing an emotional roller coaster, but again, we have a 2.7 million, whatever assigned for that, for the new pump house, that's gonna change all the stuff, isn't it? For a lot of the.
Yeah, well, you're gonna end up, you get the cash, the deferred revenue until you spend it, and then it's gonna go into revenue, and then you're gonna slowly expense that pump house over its useful life. You'll have a big revenue amount in the year, but over the years as you spend the grant. But the big thing is to receive the grant, any grants you can, apply for them. Set out your projects, apply for them, get the funding, complete the project.
Yeah.
Wherever you can. Like I said, you funded some of your capital projects with operational planning, so
So
it moves your cash down and
it'll bring it back up and we get the,
when you actually receive it, yeah.
like we were talking about with the library for having it as a liability. So it wouldn't just be like 15,000 for mold, it'd be like, it was audited for 300 grand inspected for 200 grand just to repair the basement. So it count that much as a negative it or just
what it's cost to retire it.
oh, just to dump it basically.
Yeah.
Okay.
So you wouldn't have to make those repairs.
Not if you're gonna dump it,
yeah. But you would have to clean it up. Because you can't introduce environmental substances into the atmosphere, soil, etc.
No, I was just curious how that worked.
Yeah.
Other letters are very interesting ones.
The letters are a management letter, audit findings letter. So I had a few comments on those letters. Here we go.
It was pretty boring of it though, nothing exciting, because you want it to be boring, right? You don't want to find something really.
Well, the prior period adjustment is always, we never want to have that. It's just, but mistakes happen. Things get missed. So other than that, and some of the funding, just balancing the grant funding. And then you guys ended up discovering you're gonna get funding for the pump house. So we're gonna fund things this way. Oh wait, no, we don't want to do that because we're gonna take care of the pump house. So yeah, so I'll just start listing them off. So in the manager letter, I have 3 comments. This one is on there every year. Historically, we make a number of journal entries. So we adjust your deferred revenue for grants, capital purchases, amortization. Some are they're expected from year to year. This year we did have more, but again, in prior period of adjustment, changes in funding. The reason I bring that up is just I'm only doing things at a point in time. So I audit and I give you journal entries at a certain point. Well, what are you getting for financial information before that? You could have something that not on purpose, but by accident misleads you. And you think, oh, we don't have this funding, but you do. Or we don't have this much, but you do.
Like the generator, we spent that money and then it turns out because we did that, use the engineer, we get so much we can use NSI. So it's kind of like that. Surprise, you did something right.
So that's kind of where I'm coming from with that. You capitalize something, and then I look at your TCA policy and you discover it should be expensed, or vice versa.
Yeah.
So you might think your bottom line looks better or worse. Still cash out either way on that example. But that's kind of where I'm coming from. It's the less journal entries I make means the more informed you were during the year, the more accurate your financial statements are. We found that not all the journal entries made by the village itself were signed off. So, there's regular data entry, and then there's a journal entry to fix something. Well, ideally, somebody will draft a journal entry and another person will approve it. So it's just a matter of evidencing that. It's just a procedure thing. Then the third one, I mentioned the prior period adjustment. So we found, well, Sharon brought it to our attention, but the federal gas tax funding was denied for 2019-20 for those projects I mentioned, the Uniware and so forth. I think what's happened there is just getting the SFEs, the grant reporting in a little bit late, so they don't let you know that they give you the sign off to say it's okay. So that's what's happened. So just to make sure that all SFEs are filed on a timely basis, you can't make sure that you talk to the granting agency to make sure that, yeah, we'll fund that. So just to avoid adjusting things later. So that was the management letter. I have the audit finding letter. Some of it we've already touched base on. So we don't, of course, make every adjustment. So you find out your payables are misstated by $500. We're not necessarily going to adjust that. It's just not significant enough. So we'll summarize them. If they're trivial, $500 would be we just ignore it. If it's a few thousand, now you're talking insignificant but reportable. I tend just to recommend to make those entries, and we have, because we're making the journal entry. So I made them all the ones that we found that weren't trivial. So it's just there is an attachment to the letters here. There's nothing we reported that wasn't trivial that we found. We do attach the adjusting entries to the letter as well for your sign off. So as stated, most of them are to record amortization, reclassified capital purchases, funding, and so forth. So we did have, I think it was, yeah, about 28 in all this year. Normally we're in the 15 to 18. I already discussed this, but I thought it was warranted to have it in this letter about the asset retirement obligations. So we'll need to record that in your next year end. And then I mentioned the prior period adjustment in the description. That's just, we need to put things in 7 places apparently. I don't know. That's that kind of thing.
The red tape reduction stuff.
Yeah. And then the restricted surplus I mentioned, you were underfunded there by 20,000, which will be made up in 2030. Now, these last two has to do with the way the tax penalties are calculated. You might want to revisit the wording. It reads that it's going to be taxed. You're going to charge value on all everything in the account that's overdue at point in time. So based on the letter of the law, it looks like you're not calculating the whole thing. Whether or not that's what's intended or not, I don't know. But I would just revisit that bylaw. And then water, sewer, garbage rates. I just review those again, just to make sure that everything's being charged as it should, as per the bylaw. Because we did find some discrepancies between what was charged and what the bylaw said. Significant? No.
Probably not. I was just gonna ask, are they significant, like big numbers, or just no, not really, but still discrepancies. So
Yeah, it's like every charge you should be documented, and then the bylaw should reflect exactly what you want to charge, and then you apply across all accounts. So.
how much out of whack is it gonna throw everything with the other projects come in? Like, is it just gonna change all the numbers? You mean, like, all your work is gonna be pretty, but like you said, it's a snapshot up to that point, and then that rest of the year throws all cattywampus there.
Well, yeah, that's the thing. You're gonna get all this grant funding and all these. You're gonna be spending a bunch of money on projects, so it's difficult unless Sharon might need some help with that. You know, no offense, but it's a lot of work. It's a lot of work.
Yeah.
It's,
Tina's excited to help.
if I'm not making these entries, then she's making these entries, and I know how long.
Well, Tina's smiling, she's ready for this.
Yes.
I can do this, exactly. Was there anything concerning though that you saw anywhere at all?
Well, in a bubble, the cash balance, but I know that you received $500,000 in July.
Yeah.
So earlier in the year, might have been more concerned, but
Okay.
I've got the kind of
Yeah.
subsequent event that makes things look better.
Can't think of anything else. Could I talk to you earlier on the phone, but I had no other questions. Ready? Karen? No questions? Anybody over there? It's right here. Oh, okay.
Perfect.
Thank you for your time.
Yeah, unfortunately, I got a bunch of signing.
Yeah, I was saying how we get to the signatures
Yeah.
and fun part.
So this audit findings letter, which Sharon will have a copy of. I guess this acknowledgement of council, it could be in past thing.
That's how you do that. Trying to be so subtle about it. I'll write the date for you.
Oh, well, thank you.
Now the second letter here, that's our representation letter. So you're basically signing off that you disclose everything to us, in your liabilities, legal issues, and so forth.
Should we just adjourn the meeting for the signature or should we?
Might as well.
Okay, so meeting adjourned at
2:20.
2:20.
So it's just signing off.
Yeah, we're just signing.
So was there, does it matter who? Was there a motion to?
No.
Oh, we need a motion to approve the,
Motion to approve.
okay, I'll make a motion to approve it. Everybody's in favor? Motion
Yes.
carries.
Okay. And now.
Now we can, okay. 2:21 or whatever.
I've got 222.
I knew someone was gonna do that, so.
Okay. Um,
All right, now we gotta do some financial statement signing.
Recording stopped.